In this presentation, we will take a look at a reversing entry related to accrued interest within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our Get Great Guitars file. To see our objective, we're going to go to the reports on the left side and open up those reports, looking first at our favorite report, that being the balance sheet. So we'll open up the balance sheet and we'll scroll back up top and we'll change the dates from 01/01/19 to 02/28/19, our cutoff date, the end of February, and run that report. We're looking now at the accrued interest, meaning we had an adjusting entry for interest that was accrued for which was not yet paid. So we can see that on the balance sheet, our adjusting entry, we entered into the interest payable, a liability account. It's only $25, so the dollar amount is not significant, but the concept would be the same no matter what the dollar amount is, and that is that we had a loan, it accrued interest that haven't yet had to pay. Let's consider that again from the amortization table. We're considering this type of loan over here, which we take out money and we're not going to pay it back until sometime in the future, as opposed to the typical kind of loan situation that we think of most of the time, where we pay it back on a monthly basis. If we pay it back on a monthly basis, we're paying the interest each month along with a portion of the principal typically. If we're going to take a loan out and we're not going to pay it back, we're going to say, hey, we'll pay you in 6 months from now. Then the interest just continues to accumulate over time. And in that case, we should be recording each month the use of that money, the recording of the interest on the profit and loss statement and the related liability that's going up from $5,000, the original loan amount, to $525 to the $550 and so on. That's what we did here. We said the adjusting entry said, hey, we don't owe just $5,000 anymore. We owe the other $25. That's accrued interest. That's a payable. That's a liability. So we increased the liability. On the other side, we can see it on the profit and loss statement. If we go back to our QuickBooks and take a look at the profit and loss, we're going to open up a new tab, right click on this tab, duplicate it, and we're going to pull this tab from the left to the right. So we have the balance sheet on the left, and on the right we will have the profit and loss by going down to the reports. And then we're going to select the profit and loss, our favorite report, one of the favorites, and we're going to say 01/01/19 to 02/28/19, January through February 28th, and run that report. And if we scroll down, we have the interest, and part of that interest then is going to be selected, and it says interest paid, which isn't the best name for the account. Probably it should be just interest expense, because we didn't necessarily pay it in order for the expense to happen, as is the case here. We owe this $25. It's allocated here because we incurred it. Whether we paid it or not, we owe it because we used the money for that point in time. So it's increasing the expense. There's the other side of it. Scrolling back up, we're going to go back. Now, oftentimes when we have adjusting entries, we might think about separating between the adjusting process and the accounting department. In other words, we don't want the accounting normal bookkeeping process to get mixed up from our adjusting entries. Sometimes the normal bookkeeping process is more on a cash basis, or has that system, some system that they're using that works and is more efficient. It's more easier to do logistically than doing something that would be more of on an accrual basis, and that's why we do the adjusting entry. So for that reason, oftentimes our adjusting entries, our goal then is to make the financials correct as of the cutoff, as of the end of the period, in this case the end of the month of February in this case. And then that'll make the financial statements correct as of that day, and then we can go back to whatever system is most efficient for the rest of the time period. To do that, we might want to reverse our adjusting entry and say, hey, you guys are doing great. Whatever the accounting normal process is, that's doing great, whether we're doing it or someone else. It's easier to think about if someone else is doing it, because that gives us our mind to think of two separate people. We're going to say, okay, the accounting process, you guys are doing great with that. We're going to do our adjusting entry just to make it completely right as of the cutoff, and then we'll reverse it so that it doesn't mess you up. And that's basically what we'll start to do here. We'll say, okay, we did this adjusting entry to be correct as of the cutoff date, and some of those adjusting entries, those that aren't permanent, those that are timing differences, will reverse. So in this case, why would we do that? We would say, Well, we don't want the accounting department to be confused by the accrual of interest, the interest payable that's there. And at the end of the day, when they pay the $5,152, we want them to make that entry as easy as possible, to just whatever the system is for them to record that. They're going to write a check, and the other side's going to go to interest payable or something like that, and we'll make the adjustment after that at the end of the time period. So we're going to set up a system for the entry for the accounting department to not have to worry about our accrual. We're going to say, hey, you know, here's the accrual for interest. We're going to take it off so the payable's not there. When you do make the payment at the end of the time period, you can just make the payment and either just post it just to the liability account, which means you'll have a negative liability of 152. That's okay. We're just going to adjust it to whatever we need to do in our adjusting entries at the end of the month. Or you can put the 5,000 down to 0 and put this to interest expense, which again, if you do that, again, we'll make the adjusting entry to record the proper interest expense, which will be whatever it will be for that time period. That month will be around $26 in our case. So that's what we're going to do now. We're going to separate the adjusting process from the process of the normal accounting by reversing some of the timing difference type of entries. So to do that, we're going to do that the reversing entries will always be the first day after the cutoff date. So the cutoff date was the 28th. We're going to reverse it as of March 1st, the first day of the following month. And it'll make it wrong as of the first day of the following month. But over time, the timing difference will roll out and it'll be okay. So let's see how that would work. So what we'll do is just do a journal entry to reverse this item now. Because there's only two accounts, we could use registers to do that. So I'm going to go up top and make another account again, another tab, by right-clicking the tab, duplicating the tab, taking the tab to the left of it, pulling it to the right. So we have balance sheet, profit and loss, and now the tab we will be working on, which we're going to use to go to the accounting down below. We want to be on the chart of accounts, and we're going to be dealing with the balance sheet account. There's two accounts, the interest expense, or the interest payable, the interest paid account, and the interest payable. We need to deal with the balance sheet account, interest payable, if we're going to work in this format with the registers, which we're going to do. So we want to go down by type. Here's the interest payable. We want to use that register. There's the 25. We want to use that item. And we're going to create another journal entry, and it's going to be journal entry. And we're going to make this as of 03/01/19, so the first day of the next month after the cutoff date. And we're then going to make this account go down. So the liability account, the bad thing, is going down. We're bringing it down to 0. We're reversing the increase in the liability to reverse what we did last time. The other side is going to go to interest paid, which is an expense. It's going to basically be interest expense. And that's it. This will decrease the liability and decrease the expense. However, the expense is going to be decreased in the following month, and that's going to be funny. That's going to look funny. So let's see what that does for us and what it does not for us, the pros and cons of it. So we'll say save, and then we'll go back to our reports. If we go to the balance sheet then, we can see that we have the 25 as of the cutoff date. Well, let's run it again just to make sure. Run that report. We still have the 25 as of the end of the 25th. This is as of the end of the 25th. There's the interest payable. There's the 25. Again, if the accounting department asks us about that, they're gonna go in there and say, oh, that's an adjusting entry. That's something funny that they did or whatever. If it's a different department, we'll just leave it as is and we won't touch it. And then we'll go back to our information in the current month, the new month that we'll be working on, which is March. If we change the dates, well, the end date's all we need to change to 03/31/19, the end of March, and run that report, then it's going to be gone. So if we go down here, we no longer have the liability of the interest payable because we took it out. If we select it, we're going to say that now it's reversed. So now in the current month that we're working in, the accounting department, they don't see our funny adjusting entry. It's been reversed, so hopefully it won't be any kind of confusion to that point. So then we'll go back. On the profit and loss side, we'll go to the profit and loss. We'll scroll back down. Once again, if we run that report, it's still there as of the cutoff date, as of the 28th. So we still have the 25, which is included in interest paid in this item. So there it is, the 25 right there. If we scroll back up, however, and we look at the current month that we'll be running, the month of March, we're going to go 030119 to 033119, the next month after the cutoff, after the month that we're running the financials for. Run that report. Now we have the 25 negative. So we reversed it in the month after. Note what that does. Like if I look at just the performance for this month, it's a negative number, which is kind of funny. It's not right, and it wouldn't be right until basically if the interest payment calculation was made. So when the interest payment was made, it would reverse this 25 and everything would be okay at that point in time. So it's kind of a timing difference. So we'll see this kind of reversing. It might look a little more funny. It doesn't reverse as cleanly in this reversing entry here as it will in some other entries because of the way the loan works out, meaning we're not going to pay it until the end of 6 months. So the reversing entry wouldn't really work its whole self out until the end. We're going to have to keep adjusting it at the end of the month no matter what. It'll work itself out after the 6 months, and we'll just keep correcting it as of the end of the time period to make it correct as of the end of the time period, and then reverse it so that you don't see the payable on the liability section. When we get into some of the other reversing entries, it might be a little bit more clear as to when the reversal would happen, meaning it'll happen sometime within the following month, and the income statement would then typically be correct at some point in the following month. In any case, however, the reversing entries aren't perfect accrual because the adjusting entry, the point of them is they're going to make the financials correct as of that point in time, and the reversing entries are going to make something correct or make it the process easier as of the following time period. So the point of these kind of periodic adjustments is to make the financials correct periodically at the end of the time period and to make the logistics of just entering data as easy as possible. For more accounting information and accounting courses, visit our website at accountinginstruction.info.